A shocking report out of China combined with some other market news sent stocks falling on Monday. We all want the stock market to go up. We all want the stock market to rise. But if we keep getting reports like this, it's never going to happen. Alarming China data upset the global stock markets. Chinese exports fell at the steepest pace since February of 2020. China's exports to the rest of the world tumbled in July, offering fresh evidence that a drying up of Western demand is hurting Beijing's attempts to rekindle growth. South Korea's exports fell 16.5% year over year in July, widening from a 6% drop in June. Taken together, sluggish figures in China and other parts of Asia suggest that the global growth slowdown is starting to bite harder. In other words, a global recession that has already started in Europe is now spreading throughout the rest of the world and may be coming to the United States soon if we're not already in a recession. Now, if the entire world slows down and global growth slows down, that's obviously going to hurt the United States. And in fact, we saw US imports fall in our latest data as well, showing that the US is in fact slowing down. Of course, it wasn't just this report coming out of China. There were other news that sent stocks falling today as well. Moody's cut ratings on 10 US banks and put some big names on a downgrade watch. Moody's lowered the ratings of 10 banks by one rung, while major lenders Bank of New York, Mellon US Bancorp, State Street, Truist Financial, Cullen/Frost Bankers, and Northern Trust are now under review for a potential downgrade. Moody's changed its outlook to negative for 11 banks, including Capital One, Citizens Financial, and Fifth Third Bancorp. Among the smaller regional banks receiving an official ratings downgrade were M&T Bank, Pinnacle Financial, BOK Financial, and Webster Financial. Moody said, "We continue to expect a mild recession in early 2024, and given the funding strains on the U.S. banking sector, there will likely be a tightening of credit conditions and rising loan losses for U.S. banks." Regional bank shares came under fire after the credit downgrade and headed for their worst day in 3 months. Now, even though the stock market sold off significantly in the morning on Monday, it then rallied in the afternoon and recovered much of the losses on the day, finishing the day down less than 1%. But was the afternoon rally the start of a longer-term rally where we recover, or was this just fake hope for bulls and we're just going to continue down further over the next few days? That is yet to be seen, but one thing is sure is that this bullish market momentum that we've had over the past 10 months is definitely starting to slow down, and we may be nearing the end of it. Keep in mind that as we get more and more data and more news of bank defaults and all of this other stuff, this is going to continue to put downward pressure on stocks. We already know that banks are going to be in trouble in the long term. We have a huge commercial real estate crisis on our hands, with the potential losses for banks exceeding $2 trillion. And most people think we are going to see more bank collapses later this year, especially into 2024 and 2025, as these commercial real estate loans start to default, and that in turn leads to losses for banks. We've already seen the largest number of commercial loans default since the 2008 financial crisis. We definitely have a major problem on our hands. It's not here yet, but it's definitely there on the horizon, and it's just a matter of time before investors start to worry about these things. Now, I personally sold my bank stocks on Monday over fears that more Moody's downgrades are coming and bank stocks are going to fall further, but some people believe it's time to buy the dip. A writer for Barron's said, just as economists largely brushed off the impact of the downgrade of U.S. debt, it may make sense to similarly dismiss Moody's actions on these 27 banks. While higher interest rates have meant higher funding costs, they also spurred double-digit profit gains at many banks. In other words, even though banks are facing major losses from their loan portfolios, they are also having major gains and profits on the money that they're lending out, specifically those deposits that are sitting at these banks, where the banks might be paying 0.1% interest, but they are collecting 5 or 6% interest from treasury debt. So, in one hand, the banks are facing major losses on commercial loans. On the other hand, banks are facing major profits on the deposits that people have at the bank. The question ultimately becomes, will those profits offset the losses from the loans? This may very well be a buy the dip opportunity. It's just, for me personally, I think in the very short term, we're going to get more downgrades on the banks, and that's going to cause more downward pressure on the stocks before we actually do hit a bottom. I don't think we've quite hit the bottom on these bank stocks quite yet. And as banks roil with bad debt, consumers are finding themselves in a similar situation. Consumers have been out of cash for a while, spending money on credit cards in order to pay their bills, and credit card balances jumped in the second quarter and are now above $1 trillion for the first time in history. To make matters worse, mortgage credit availability has sunk to a decade low, the lowest level since 2013. And if things weren't bad enough for consumers, one Wall Street strategist says the U.S. may have lost jobs last month. In short, the U.S. jobs numbers, the official numbers from the federal government, have a lot of issues with them, with their adjustments that they do for seasonality and payroll adjustments. A lot of people look at the household data as being a lot more accurate than the jobs data. Still, the government does use the official jobs data to report their numbers. And some people who have been looking at the jobs data are starting to scratch their heads and say, we don't really think this data is very accurate. It actually looks like instead of creating jobs last month, we very well may have lost jobs. Somewhere between 30,000 to 100,000 jobs may have actually been lost. And this shows up in the leading data, it shows up in the household data, it shows up in a lot of data points. It's just not showing up in the official jobs data, which is why some strategists think the official jobs data might be wrong. And if it is wrong, then that means the economy is slowing down and we could be headed for a recession. And the job market could get even worse over the next 2 years. A $1.8 trillion wall of corporate debt is coming, which could cost jobs. Big corporations aren't likely to avoid the bite of higher interest rates forever, particularly with an estimated $1.8 trillion wall of U.S. corporate debt coming due in the next 2 years. The thing you have to understand about corporate debt is it's very different from personal debt. As a person, when you go into debt to, say, buy a house or buy a car, you are being locked into a fixed interest rate for a set period of time. On a house, it could be 15 or even 30 years. On a car, it might be 5, 6, 7, now even 8 years. And the problem is businesses don't really work that way. Businesses get into very short-term debt where they will get a loan and they'll pay that loan off for about 2 or 3 years, and then the loan balloons and they have to refinance that loan. So every 3 years or so, corporations have to refinance their debt, which worked fine while interest rates were near 0%. But now that interest rates have skyrocketed to over 5%, the cost of maintaining that debt is about to skyrocket. And as companies get much higher costs, they're going to have to cut back on those costs somewhere. That means companies could start cutting jobs and rolling out other belt-tightening measures. Corporations needing to refinance existing maturing debt at today's higher rates would face higher debt costs. Goldman's economics team expects a 2% increase in interest rate expenses for corporations in 2024 and a 5.5% jump in 2025. A bigger burden in terms of interest rate payments typically translates to cuts in labor costs and capital expenditures. Now, if there was any good news today, it's that Philadelphia Fed President Patrick Harker suggested that interest rate hikes might be coming to an end. Harper said, absent any alarming new data between now and mid-September, I believe we may be at a point where we can be patient and hold rates steady and let the monetary policy actions that we have taken do their work. Now, his statements actually weren't really all that shocking, given the fact that the Fed had previously said that they might go to an on-again, off-again type of rate increase cycle, where they pause, then they raise, then they pause, then they raise. We got a raise last time, which means next time should be a pause. And that's exactly what futures are predicting. Futures traders are pricing in an 86% chance that the Fed is going to pause in September. On the downside, Harker indicated that there are unlikely to be any rate cuts anytime soon. He said, allow me to be clear about one thing. Should we be at the point where we can hold steady, we will need to be there for a while. I do not foresee any likely circumstance for an immediate easing of the policy rate. The stock market is still pricing in 2 rate cuts before the end of the year, and if Harker's statements do come out to be true, the market is going to have to reprice in this higher for longer that the Fed keeps talking about. And with today's slide adding to last week's sell-off in the stock market, traders are beginning to wonder how much further the S&P 500 could slide. Well, based upon technical analysis, selling pressure could push the S&P to 4,300. A fall to 4,300 would represent a roughly 6% pullback from July's closing high. That kind of dip is normal during larger bull markets and is really nothing to worry about. But one researcher has recognized a complicated options trade that originally helped prop up US stocks is starting to unravel. Should the complicated options trade come completely unglued, the result would be a nearly 500-point shaved off the S&P 500 index from here, a move that would erase much of this year's nearly 18% gain. So as far as how much the stock market might fall, we're talking somewhere between 6 and 18% from highs. Now, we already had more than 2% fall last week, so maybe down another 4 to 14%. Now, as the stock market falls, there's no need to really lose money here. There are certainly ways to profit. In yesterday's video, I talked about possibly buying call options on the VIX. I do want to be very clear that anything I talk about is not a recommendation to go out and buy, sell, or hold any asset. I am not a financial advisor. I'm not telling you what to do. I'm just letting you know what I would do, and in fact, what I have done. I did buy call options on the VIX. I bought them for October at the 20 strike price. Those are up, especially after today's rise on the VIX. Now, yesterday, I had also mentioned that the market sentiment remains quite bullish. And there was some confusion. Well, if stocks are still bullish, why make a bearish play? And as I explained, this is really more of a hedge at this point. Not really that I feel stocks are going to go down so much that I want to turn into a bear. This really is still bullish. But we do have to understand that looking at technical analysis on the daily charts, all 4 major indices, the Dow, the S&P, the NASDAQ, and the Russell, all 4 of them are bearish on the daily charts. However, all 4 are also bullish on the weekly charts. We are literally in this situation where we have 100% bearishness on the daily charts and 100% bullishness on the weekly charts. What that means as a trader is that we should be short-term bearish and long-term bullish. So if you have a long-term time horizon, this might be a great time to buy the dip. If you have a short-term time horizon, this might be a great time to buy put options. And by the way, that ultra bullish market sentiment I mentioned yesterday, well, it's starting to fall. We finished 6 weeks in a row at extreme greed. 1 month ago, we were at 77 on the greed chart, but yesterday we were down to 72, and today we're all the way down to 70. Most notably, safe haven demand is in the fear category, meaning some large investors are starting to pull their money out of the stock market and put it into bonds, which are a lot safer should the stock market fall. Now, if you do want to trade the short-term downfall of the market that we might get, given the fact that August is normally flat and September is normally the worst month of the year for the stock market before we typically bottom out in October and then continue our rally. If you want to play a downturn in the stock market over the next 2 months, like I said, I do expect us to bottom out and rally again in October, but for the next 2 months, there's certainly some plays here to make money. If you're not able to buy call options on the VIX like I did, there are other ways to play this as well. One I do not recommend is to go do a VIX ETF, something like UVXY or VXX. The problem with these is that these are designed to go down over time. They're designed to lose money over time. So if you hold them for 2 months, you're very likely to lose money even if the VIX goes up. A better play would be to do a different type of inverse on the markets, specifically looking at the S&P or the NASDAQ. And those two ETFs that you can buy include SQQQ to short the NASDAQ and SPXU to short the S&P 500. So if you don't want to buy call options as VIX, or if you're not able to, you might want to consider SPXU or SQQQ in order to short the market for the next 2 months. Now moving on to the individual stock market news on Monday, Novavax shares jumped after their COVID vaccine maker posted a surprise quarterly profit. Unfortunately, that pre-market rally quickly sold off and the stock finished the day down nearly 4%. And ESPN announced they are launching ESPN Bet in a new agreement with Penn Entertainment. Stock ticker PENN has secured the exclusive right to the ESPN Bet trademark for an initial 10-year term, which may be extended for an additional 10 years upon mutual agreement. The online Barstool Sportsbook will be rebranded ESPN Bet in the fall of 2023. ESPN Bet, which is operated by Penn Interactive, will benefit from exclusive promotional services across ESPN platforms, including programming, content, and access to ESPN talent. The agreement enables efficient customer acquisition and retention spend across the premier sports content. Going into today's announcement, PENN was a severely undervalued stock, a classic value stock, as you will, and today's announcement sent the stock up 18% after hours. Unfortunately, for every winner, there is a loser, and the loser was DraftKings. DraftKings stock was down about 9% as of the recording of this video. And NVIDIA revealed a new AI chip, said its cost of running LLMs will drop significantly. This news was widely expected, however, and NVIDIA followed a classic buy the hype, sell the news. The stock was down about 1.6% during the day. And UPS stock dropped after their revenue missed and they lowered their outlook. UPS stock was down less than 1% on the day, though, so it didn't hurt the stock too much. Rivian raised their 2023 EV production guidance and posted a narrower than expected quarterly loss. Rivian now expects to build about 52,000 vehicles in 2023, which is more than double the number it made in 2022 and up from its previous production guidance of 50,000 vehicles. Rivian's loss came in much better than expected at only $1.08 per share versus $1.41 expected, and revenue came in better than expected as well at $1.12 billion versus $1 billion expected. Rivian stock was up about 2% on the day and an additional 1% after hours. But Upstart stock plunged after their earnings as their forecast came in light. The company, which uses artificial intelligence to inform lending decisions, reported a second quarter net loss of $28.2 million or 34 cents a share, compared with a loss of $29.9 million or 36 cents a share in the year prior. But revenue fell to $136 million from $228 million a year prior. This just goes to show that just because a stock uses AI, or just because a company mentions the word AI, that does not lead to profitability. Look, AI is a cutting-edge technology. There's a ton of AI hype out there, and people think AI is going to change the world, and it will, but it's not there yet. And companies that are involved in AI are having a very difficult time making AI profitable. So we may very well be in this place that we were in the year 2020 when there was this major hype around .com stocks, only to see those .com stocks fall by 80% in the year 2001. So we may be in this period as well, where investors are starting to wake up to the fact that AI, while it could change the future, doesn't necessarily lead to profitability. And as customers get their eyes off of the AI hype and investors start focusing on profits over AI hype, we could see stocks start to fall. That certainly happened with Upstart, with their stock down 20% after hours. And AMC stock also reported earnings on Tuesday. Their stock rallied initially after swinging to a profit, boosted by the highest quarterly attendance since 2019. But one analyst says AMC could still face bankruptcy if the ape conversion battle fails and strikes in Hollywood drag on. Despite the initial rally, AMC sold off, finishing the day down and falling an additional 1% after close. So that's what news moved the stocks on Monday. Now, if you're not able to trade something like VIX call options, I recommend you download a broker that allows you to do so. Webull allows you to trade VIX call options. Webull is a great platform. Right now in the US, they're offering over 12 free stocks just by downloading the app and depositing at least $100. You're going to get anywhere from 6 to 12 free stocks here in the US. And Webull just launched in the UK. That's right. Webull is now available in the UK. Now, Webull doesn't quite have options trading available in the UK yet, but they are bringing it. It will be available in the UK very, very soon. So if you want to start trading options in the UK, download the Webull app, make your $100 deposit, get some free stocks, and you will be ready to go for when options trading hits the Webull app here in a few months. It's a great offer to jump in if you're in the UK right now to start trading options at a very, very easy way. Webull is by far the easiest platform to use. And if you're in Canada, Moomoo is now coming to Canada. If you want to sign up for Moomoo in Canada, maybe use something a little bit better, easier, cheaper than Questrade, then check out Moomoo for Canada. Links are in the description below for all of these. It doesn't matter if in the US, Canada, UK, or Australia, there are promotions and offers available for you. Check out the links down in the description below. And if you got a lot out of this video, then be a good friend. Share this video on your social media pages so that others will know what's going on in the market as well. Don't forget to hit the like button and subscribe. And if you missed yesterday's video where I covered more market news that moved the markets, make sure you check out yesterday's video right here.